Hello, everybody, and welcome to Rosano Capital's first in a series of educational webinars designed to empower you with knowledge to help you make informed decisions to accomplish your long-term financial goals. Today's topic, we'll be discussing what a prepayment penalty is. Now, what you will learn today are essentially four things. First, what a prepayment penalty is. Second, what the pros and cons of a prepay are, and yes, there actually is a benefit to having a prepay. Third, you will learn what the difference is between a hard prepay and a soft prepay. And finally, you will learn how to calculate the specific amount of a step-down prepayment penalty. Now, it should be noted there is actually another type of prepay known as a yield maintenance fee. And we'll discuss that in more detail in another upcoming webinar. So what is a prepayment penalty? Well, a prepayment penalty is a provision in the mortgage contract which says that if the mortgage is prepaid within a certain time period, a penalty will be assessed. Now let's take a step back for a moment and really try to understand what this means or how it really affects a borrower. You've got a bank or a lender that essentially lends money to a borrower, and if the borrower pays back that money ahead of time, the bank may assess a fee. Now you might be wondering, why would a bank do so? Wouldn't a bank or lender be happy that a borrower is actually paying back their debt ahead of schedule? Well, not necessarily. You've got to keep in mind why a bank lends that money in the very first place. Well, they do so because they are hoping to earn a specific rate of return for their investors or their depositors over a specific period of time. And when a borrower pays off that loan ahead of time, they in essence are reducing the yield or the rate of return that the bank or lender had anticipated on receiving. So, in an effort to dissuade a borrower from potentially prepaying that loan ahead of time, they assess these fees. Now, why would anyone ever want a prepay? As mentioned earlier, there actually is a benefit to having a prepayment penalty. And that benefit is money. That's right, pure hard cash. You see, typically loans that contain a prepayment penalty will have lower interest rates than those loans that have no prepayment penalty. So let's take a look. Here we have two loans side by side. They are both $900,000. However, the one on the left contains a prepayment penalty, and you can see that the interest rate is at 4.5%. The loan on the right contains no prepayment penalty, yet has a slightly higher rate at 5.5%. Now, they're both 25-year loans or 300 months, and you can see the loan on the left, the monthly payment is $5,002, whereas the loan on the right is about $5,526, amounting to a $524 savings per month. And if you were to look over 5 years, if this loan were to be kept over 5 years, you would actually save $44,180 by taking the loan that has the prepayment penalty. However, notice I said the word if. That is a very key word to keep in mind, because this, or I should say this benefit, is only applicable if the loan is kept. Now, let's take a look at the savings over a 1-year period. So once again, this is a 5-year period. Let's take a look over a 1-year period. You can see here, you're still saving some money. You're still saving $8,977 by going with the loan that has a prepayment penalty compared to the one that has no prepayment penalty. However, let's let's just assume that in this scenario, the seller decides to refinance in month 12. And there are many loans that contain what is called a 54321 step down prepay. And don't worry, I'll go into more detail on how that works later. But essentially, what that means is if you were to refinance within that first year, you would be assessed a 5% prepayment penalty. So let's take a look at how that affects us. 5% of loan balance. And as you can see here, I put a little note here that if you are paying it during the first year of what I referred to earlier, the 54321 prepay scenario. So what is 5% of that loan balance? Well, using that $900,000 as an example, 5% of that 900,000 would be 45,000 bucks. Now, I should point out that in actuality, if you were to pay off this loan in the 12th month, it would not really be $900,000. It would be about 890 something thousand dollars. Please keep in mind there is amortization. You know, every single month you're knocking out some of the principal, but for example's sake, we're just going to keep it nice and round. Nice figure, $900,000. So once again, this is in the context of a seller refinancing in the 12th month, the very first year. So they're going to be hit with a $45,000 fee. Compare that with the $8,977 savings by taking the lower rate. So you can see that in this specific scenario, having the lowest interest rate was actually not the best deal. And ultimately, the easiest way, and in fact the smartest way in my opinion, to determine what is the best option for yourself or for your clients is, what are your long-term plans? You can't just focus on the rate. You really have to know what do I plan on doing with this property? You know, is this a long-term play? Do I want to fix it up and sell it in a few years? Or, you know, the more solid and concrete you know what you're going to do in the future, the easier it is to know what options make sense for you or your clients. Now, we're going to be discussing what the difference is between a hard prepay versus a soft prepay. Well, a hard prepayment penalty, you would be assessed a prepayment penalty for refinancing the mortgage or selling the property. And for those of you not familiar with refinancing, what that essentially means is if, let's just say, you're paying 5% interest rate and suddenly mortgage rates are 3.5% or 4%, you may want to take advantage of those lower rates. So what you do is you essentially refinance. You pay off the old loan with a new loan. So if there's a prepayment penalty, however, the bank's saying, well, you know, that's all fine, you know, if you want to get that lower rate, but we're going to assess a fee. Now, in a soft prepay scenario, you will still have a penalty for refinancing your loan. However, there would be no prepayment penalty if you were to sell the property. So that's the big key difference between a hard prepay and a soft prepay. The ability to sell the property, the subject property, without having a prepayment penalty fee. Now, in our next slide, we're going to calculate the exact prepayment penalty for a step-down prepay. And I should point out that there are actually a variety of names for a step-down prepayment penalty. It could also be referred to as a sliding scale, a graduated prepayment, declining percentage prepayment, as I mentioned earlier, 54321, essentially meaning 5% the first year, 4% the second year, 3% the third year, 2% the fourth year, and 1% the final year. You can also see many other variations of that theme, such as maybe 3% the first year, 2% second year, 2% the third year, 1% the fourth year, 1% the fifth year. I know, it's painful, but hang in there. We're almost there. We're almost near the finish line. So let's use the 54321 as a good example. As mentioned earlier, if you pay off the loan in the first year, your penalty would be 5% of the loan balance. Likewise, if you pay off the loan in the second year, or let's just say month 13, for the rest of that year, your penalty would be 4% of the specific loan balance. If you pay off the loan in the third year, the penalty would be 3% of the loan balance, and so forth. So let's get into some hard numbers here. Using that same scenario that we had discussed earlier, you've got a loan amount of $900,000. It does have a prepayment penalty. Let's say the 54321 that we had just discussed, 4.5% interest rates, monthly payment of $5,002 every month. Well, at the end of 3 years, you or the borrower has paid about $180,000 in total payments, of which $62,000 of that has been applied to the principal and $117,000 has been applied to the interest, which leaves a balance of $837,397. So let's keep that figure in mind. This is the balance at the end of 3 years, 837,397. If a borrower were to refinance this loan at the end of 3 years, what you would do is you would take 3%, multiply that by that loan balance, and this would be your prepayment penalty, $25,121.91. You did it. We're at the end of the webinar, and hopefully this did give you a little bit more feedback as to how to calculate prepayment penalties, in what scenarios they can be useful, and in what scenarios they should be avoided at all costs. Now, for more webinars, reports, and news updates, please like us on Facebook, facebook.com/Rosano Partners. Should also point out that on our Facebook, you'll also find information regarding other commercial real estate topics, not just finance. However, on our Twitter, this will be dedicated specifically to commercial mortgage related topics. Thanks very much for your time, and looking forward to speaking with you real soon. Take care.